So we are in full-blown economic war. We have seen the weaponization of the dollar, financial sanctions, and price caps on Russian oil. But what Ukraine just did takes this conflict to the next level. A major oil refinery in Russia has been hit by drone attacks and it has caught fire. And this is a critical development because it tells us how this war is evolving. Not only is Ukraine hitting military targets, they are striking economic ones deep into Russia as well. Last December, it was a railway attack, and that was bad enough. But striking refineries doesn't just piss Russia off, it also affects the global supply and demand of oil products. The target was in the Novgorod region, well into Russian territory, a fair distance away from the front lines. And what we are seeing are big attacks of desperation on Russian infrastructure to try to halt the war machine financially. Now, it's quite obvious that things aren't going very well on the front lines, and the hope here is to cripple Russia financially to stop revenues from coming in. But as you quickly see, this doesn't really make a serious dent. It will only prompt Putin to shift his economic game plan. It will push Russia even closer to China. According to the reports, the North Sea refinery processes 15.8 million tons of Russian crude a year, which is around 5.8% of total refining production. The plant accounts for 11% of Russia's gasoline output, 6.4% of diesel, and 5.6% of fuel oil. So it is a significant amount that can affect supply and demand. Now, the immediate response from Russia would be very straightforward. If things get truly bad enough, they could simply halt exports of their refined fuels. Now, they've done it before with gasoline. To combat high domestic demand, Putin slapped a ban on all exports for 6 months. What this attack could do is to make the ban even more severe. Russia could extend the ban to 9 months or even a year to satisfy their domestic demand, both civilian and military. Russian gasoline exports average only around 500,000 tons a month or 6 million tons a year to the world. Even if the entire North Sea refinery blows up and 5 million tons gets taken out of the equation, this won't cripple Russia just yet. Banning gasoline exports can help fulfill demand on the ground. Now, Ukraine might be thinking of taking down Russian refining, but they will have to simultaneously strike multiple plants at once, and it's obvious what Zelensky is really trying to do. He wants to show the West, especially the US, that they can still fight the war, and to win, you can't stay defensive forever. He wants to show that Ukraine is willing to go on the offensive and do whatever it takes to win, even if it means targeting infrastructure like oil refineries. And this, of course, is a big push to get the US to cough out $60 billion. And the level of desperation is starting to build, and they kinda know the game is up if Biden loses the elections. In a stunning statement, Viktor Orban revealed what will happen if Trump gets into office. If Trump wins, he wouldn't give a penny to Ukraine. It would essentially be game over, and this came directly after Orban met Trump in Florida. So you can imagine the conversations that were discussed about Russia, NATO, and of course, funding Ukraine. And I kinda bet Trump is formulating a game plan to exit the war. But let's analyze a little deeper into the refinery attacks. Will it really cripple Russian revenues? And who are the biggest losers of this hit? Now, back in September last year, Russia imposed a diesel ban that took away 1 million barrels a day of exports. And this was a big deal because diesel is used in everything from shipping to manufacturing. While it lasted only 2 weeks, it pushed prices in Europe higher by $45 per ton in a single day. Now, Russia accounts for 13% of global diesel supply, so any supply curbs can send prices flying up. And this is the danger of hitting economic targets. The idea might be to cripple Russian revenues, but it will affect the global economy and keep energy inflation higher. Looking at Russia's diesel flows, it's easy to assume that the West won't be affected. The majority of imports since February 2023 went to countries outside of the West, including Asia and Africa. But the Eurozone supply comes from countries like India and China, both of which source their crude from Russia. So if a diesel ban is imposed again, margins will rise, which will also push crude oil prices higher. And this will eventually explode the price Europe has to pay for the fuel. So there are deadly consequences when you mess around with global oil markets. It might hurt Russian revenues in the short term, but it will also hurt the G7 and the global economy as well. However, here's the reality. The attacks won't destroy Russia's economy, it won't even shut down the refineries for long. The last attack on Russia's refinery happened back on the 9th of February. It caused some disruptions, but operations recovered and oil refining rose back to 5.4 million barrels a day. In just 2 weeks, business was back to usual. If we look at the effects of the Ukrainian drone attacks, it hasn't affected refining operations much. Since the start of the conflict, Moscow has been refining well above 5 million barrels a day of crude oil. Nothing materially has changed. But this is still important news. It tells us that nothing is off limits, and if Ukraine gets bigger weapons from the West, they may go beyond drones and use things like missile snakes. But what's more concrete is the future steps Russia will take to secure their supply of diesel and gasoline. And this will bring Putin and China closer than ever before. China has the world's largest oil refining capacity. They can refine 920 million tons a year, equivalent to 18.4 million barrels a day. And that's more capacity than the US. It allows Beijing to export fuels to Russia if there's ever an emergency. So, in a worst case scenario, crude oil goes to China, gets refined there, and the products get shipped back to Moscow. If there's ever a big disruption, China can do the refining. And once again, hitting the Russian refineries won't really cripple Putin. Russia still has a ton of economic support from the global south. Hitting refineries in Russia will only drive them even closer to China. Now, the only way is to cut off their supply of crude oil, which simply isn't feasible. It's not possible. The price caps aren't working, and Russia's exports have hit the highest level in 2024. Moscow seaborne crude shipments just hit 3.7 million barrels a day last week. Because of this, oil revenues are starting to surge back up to the pre-war levels. We can see the value of exports rising back up 12 months after the price cap. Exports have hit nearly $1.9 billion a week, and this isn't stopping. By hitting the oil refineries in Russia, Ukraine is increasing the demand for crude oil. Other countries will want to buy more oil to refine it to gasoline and diesel to earn the margins. And that in turn increases the price of crude oil and bolsters Russia's main source of revenue even more. And that's how interconnected the oil markets are. If we look at the price of crude, it is staying persistently high despite a weakening economy. Prices are rebounding back above $80 a barrel. This is now a supply side problem, and attacking more refineries could make this even worse. It's bad for the global economy, it makes inflation sticky without really hurting Russian revenues. So this economic war isn't going to stop, it's just going to escalate further, and now we have China shifting away from the West as well. As the US continues hammering Beijing with a ton of cheap sanctions, China is turning their back on US grain. They have cancelled a record number of wheat shipments from the US. It's the third straight month of cancellations, bringing the total to over 500,000 tons. This is the most amount since 1999. For decades, China has been buying lots of US wheat. They have a big population to feed, so the need to import food is always there. But in 2024, China's wheat cancellations have hit record highs. 240,000 tons last week and a further 260k tons this week. Cancellations have happened before, but never at such big amounts. There must be a deeper reason here. And this is ominous for the US agricultural sector. As a result of this cancellation, wheat prices fell by almost 3%. The announcement itself was enough to shake prices. Why? Because China is a huge importer of American grain. Just in the US alone, Beijing accounts for 7% of total US wheat exports. It is the fourth biggest destination, and cancellations at such a massive scale can plunge the price of wheat in the US. And this shows a couple of things. Firstly, China is buying cheaper wheat outside of the US. The majority of imports comes from Canada and Australia. But let's focus on the decoupling of supply chains between the US and China. And by now, we know this economic war isn't going to end. And America has reconfirmed their commitment to contain China to suppress China down. The US has vowed to curb China's technology. They will do whatever it takes. So more tax sanctions and export bans are going to happen. The chip bans we see here today, that's just a start. It's going to spiral out of control. And according to them, we cannot allow China to have access for their military advancement to our most sophisticated technology. Now, we have of course heard this before, it's nothing new, but focus on where this statement was said. Where was Ginay Raimondo when she said this? She made a statement in the Philippines. The US went in with $1 billion in investment to build up semiconductors there. So it isn't just supply curbs to China, but building new supply chains outside of Taiwan as well. And that's why we are beginning to see China also diversify their supply chains, especially with their food imports. Eventually, Beijing will catch up with US technology. It might take 5 to 10 years, maybe even 15 years, but the gap will eventually close. It's just a matter of time. However, what China can't risk is their food supply being controlled by the US and other G7 exporters. Food is an existential issue for China. Cutting away US wheat is a signal that President Xi wants to diversify their food imports away. Now, back in January, China telegraphed the punch that a move away from Western grain is happening. Beijing approved wheat exports from Argentina for the first time in history. And that is a good move to secure their supply chains. Argentina also benefits as well. Milei needs desperately to grow his exports to the world, so it's a win-win proposition here. But that's not all. In October last year, China also signed the biggest grain supply contract with Russia worth $26 billion. And this is the largest contract in history between the two countries. And this will only continue. We can expect supply chains between the US and China to fray apart even further. The level of mistrust is breaking new records every single month. And this decoupling is going to plunge the world into perpetual inflation, which brings us to our final story of the day, the resurgence of US inflation. And there's a clear reason why the Federal Reserve doesn't dare cut rates, why for months Powell has been waffling around the subject of lowering interest rates. During a hearing, Powell told Congress that the Fed just needs a bit more evidence. He needs to see inflation headed down towards 2% target. Well, Powell can kiss that dream goodbye. Inflation isn't coming down, it's going back up. The Fed is losing the inflation fight, and we can kiss goodbye to early rate cuts. Consumer prices have risen by 0.4% in February and by 3.2% a year ago. Prices are going higher, which shouldn't be a surprise to us, considering the chaos happening globally. We have the US government spending money like drunken sailors. OPEC Plus is also cutting crude production, not forgetting two hot wars, one in Ukraine and the other in the Middle East. 2% inflation will be a fantasy for a very, very long time. And we can see this reflected in energy prices on a month-to-month basis. Compared to January, energy prices across the board have increased by 2.3%. Gasoline in particular saw the biggest increase of over 4%, so filling up the tank in your car is going to get more expensive. This is supply side inflation that the Federal Reserve can't control. They can't raise interest rates anymore without collapsing the economy, and neither can they lower it. It will just make inflation even worse. Powell can't stop the war, he can't get OPEC Plus to pump more oil, and he can't stop the Red Sea attacks either. All these events are outside of his control, and every single one of them contributes to the resurgence in global inflation. And let's put ourselves in the shoes of the Fed. Here's what Powell sees. The headline CPI has rebounded back up to 3.2%. Core inflation is still stuck near 4% and has hardly moved. Higher prices are simply too sticky. In other words, the Federal Reserve is screwed. They don't have the evidence they need to justify their rate cuts. The timeline has been pushed back even further now, and this poses a big risk for the US economy. The longer rates stay high, the bigger the risk of something blowing up. Firstly, there's the commercial real estate problem that's far from resolved. Over time, more building owners will throw in the towel. They'll start more fire sales. They'll desperately need interest rates to come down, or else the implosion will get even worse. People aren't heading back to the office now, so rents are coming down. Interest rates staying high means repayments and refinancing stays high as well. The financial bleeding is getting from bad to worse. According to the IMF, commercial real estate in the US today is the worst hit since the 1960s. Prices have seen the biggest collapse, coming down the most since the start of the rate hikes. It's like a house of cards out in the open, waiting for the next breeze to crash everything down. Sooner or later, these losses will have to be priced in, and when that happens, that could take down the entire financial system. And the second risk is a more likely one, that the market correction might be coming. We know the stock market doesn't make sense anymore. It's decoupled from reality and it doesn't reflect the real economy. But what matters here is how many rate cuts the market is pricing in. Markets are pricing in 3 rate cuts, bringing down the Fed funds to 4.5% by December this year. However, if inflation keeps heading up, if the rebound continues, even 3 cuts might not come to pass, and that might be enough to trigger a correction in asset prices. Remember that asset prices today are priced for perfection. So even though the markets are going higher, it's really important to be aware of the inflation risk. It's not over yet, and with the hot wars getting from bad to worse, all bets are off. Ukraine is now striking Russian refineries. China and the US, they are decoupling key sectors, and this will make inflation a persistent problem for many years to come. But let me know what you think. Is the attack on Russian refineries serious? And will inflation continue rebounding higher? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these crazy times.